Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Dominic Rinaldi.
Welcome back to M&A Unplugged. I'm your host, Dominic Rinaldi. I'm often asked why M&A deals fail. What do we see when things go wrong? And so I sat down recently and put together a top 7 list of the reasons that deals fail. Obviously, there's way more than 7 reasons that a deal can fail, but these are the ones that we hear about and see more often than not. And if you can get an understanding of these and get prepared, you can avoid these in your own transaction. And so what I'm going to talk about today is I'm going to lay out what the 7 reasons are, and then things that I think you can do to mitigate falling into these traps. And if you're armed with this knowledge and you put together a great M&A advisory team and a well thought out plan, I promise you'll increase your odds of success dramatically. Before we get into today's episode, however, we created a best practices and a checklist for how to conduct diligence. This is a free resource, and it's available on either of our sites, sunacquisitions.com or K2 Advisor, 𝐾2ADVISER.com. Take a minute to download this tremendous resource. It's a great starting point for you and your advisors when you're contemplating an acquisition. And as always, thanks for being here, and I hope you enjoyed today's episode. So today, I'm going to dive into the top 7 reasons M&A deals fail. And so for purposes of this podcast, let me describe what I mean by failure. And it's not necessarily what you think. It doesn't mean that the deal unraveled completely. And sure, that's the most catastrophic result of an M&A deal. We don't see that very often where an entire business just imploded and went away unless there was something happening in the economy or completely outside of somebody's control. More often than not, what we see happen is that a business, when it does fail, reduced in value due to some reason, and then the new owner had to turn around and sell it at a reduced value. Or someone took over the business and faced immediate and probably significant speed bumps like client or employee defections, vendor issues. And these are the things that cause you to miss your return on investment targets. And we've talked about this before. Every deal, whether you're an individual investor or you own a company and you're growing through acquisition, you should have ROI targets for every acquisition that you're looking to make, because you have to have some measurement of whether or not the deal was successful. And ROI doesn't always have to be a financial metric. We believe that you should have a financial metric all the time, but there might be other metrics that you put in place to determine if a deal was successful or not. But having a metric or metrics is really critical to knowing whether or not the deal turned out the way that you were hoping. So with that said, let's dive in to this top 7 and talk about what they are and how you can avoid this. So number 1 on my list is you didn't have a solid acquisition plan going into it. We see so often that people will just launch a search because they wake up one day and they decide they want to either own their first business or they want to grow through acquisition. And they didn't really take the time to build a comprehensive strategy. And comprehensive strategy includes a lot of things. It's really taking a step back and deciding, what are your goals? What makes the most sense? How are you going to go about sourcing those opportunities? So plan has lots of, how are you going to finance it? It has lots of pieces, and you should do this work well in advance of ever hitting the market. So when you decide that an acquisition makes sense, here's some of the things that I think you need to do in order to make sure that you don't fall into this trap and have your M&A deal fail. First off, decide, is this a diversification play? Are you looking to grow through acquisition, or is it your first acquisition? And I'll tell you, if it's your first acquisition, you need to make sure that you really do your homework. You need to understand what sort of sectors make sense, what industry sectors, and then once you get into the sectors, peeling the onion back a little bit from there and deciding what businesses, what types of businesses inside of those sectors make the most sense for you based on your skill set, your background, your experiences, what you're trying to do with your company if you own an existing company and you're looking to fold something into it. What are your goals? Are you looking to add clients? Sometimes maybe you're just looking to add technology and it's a technology play. And in that case, maybe you don't want to buy an entire business. Maybe you just want to buy technology and strip it out of an existing business. Maybe you want to go out and grab talent because your current business is lacking talent, or you just can't source enough good talent, and making an acquisition will help you do that. Maybe it's a geographic expansion that you're looking for. You want to open up a new geography and expand that way. What size range are you looking for? You know, understanding the deal size is so important because that will have an impact on how you're going to finance the transaction, what sort of debt you're going to want to put on the deal. And then as a part of that plan, really understanding what your return on investment model is going to look like for that acquisition. So you have all these pieces in place. And if you have that plan, now you can go execute against it and you can move swiftly, especially in today's market. And I know that might sound surprising to people, but this market right now is really a seller's market. There are so many buyers in the market today right now looking for acquisitions. You want to have your plan put in place so that when you do hit the market, you can move fast. And we can talk about why is the market so active? Why are there so many buyers? I think I've covered this in a number of other episodes, but in short, interest rates are at historical lows. Money is so cheap and organic growth is very hard. So acquiring a business has become one of the primary paths to growing, or even for people who are looking to own their own business. You know, finding a job right now is really hard, and buying your own business and controlling your own destiny is the path. And so tons of buyers in the marketplace. Have a plan, know what you want to execute against, know what your end goal is, what is success look like, and then you can go ahead and launch your search. The next reason M&A deals fail is people just flat out overpay, or they make valuation mistakes. And this may come as a surprise, but over 70% of M&A deals fail to meet their ROI targets. That doesn't mean that the deal was a failure. It just means that they failed to meet whatever the ROI targets were. That's a very high percentage. And why does that happen? It happens because either people don't stick to their model. So what is your model of success, so that when you're valuing deals, you know what the benchmarks are and you stick within your model, you stick within your comfort zone. Or people allow market pressure to pull them outside of their ROI targets. And honestly, we're seeing that happen a lot right now. We're seeing where valuations are hitting higher and higher levels. Owners are in the driver's seat when it comes to marketing their businesses and offers. And so people are being pulled outside of their comfort zone. And when you do this and you overpay or you make valuation mistakes, it could lead to some significant challenges in the business. So what are my recommendations here? How do you avoid overpaying? How do you avoid making these valuation mistakes? First off, hire valuation experts, especially if you've only done this a couple of times. And if you've never done it, you certainly need to hire valuation experts. These are people who do this day in and day out. They're going to know what the market's looking like. They're going to know what the trends are, but they're also going to know where the tolerance levels should be. And these experts will help guide you and make sure that you're not making mistakes that you then can't recover from later on. The other thing is make sure that you're securing comps. Now, in the business for sale marketplace, there is no such thing as the comparable in residential real estate, which is the MLS. So there is nothing publicly available for you to track what are other deals selling for. These are usually confidential transactions when it comes to closely privately held companies, but valuation experts and M&A advisors have access to comps, and you're going to want to understand what current deals are selling for and what are the ranges of values, so you know that you're not overpaying, or if you do overpay, you're not so far outside of the normal range that you're going to put yourself and your deal in risk. And the other thing that I mention to people in this category of overpaying or making value mistakes, if something doesn't make sense around the financials or anything in due diligence, follow the trail. Don't give up. If you just don't feel comfortable, keep asking questions, keep digging, figure it out, because this is one area where you can make a small mistake, or what seems like a small mistake, and then it's going to come back to haunt you later on, and you realize it was really a big deal. So usually I like to follow my gut. I tell my clients to follow their gut. If something doesn't seem right, follow the trail, continue to ask questions. And the last thing around overpaying and making valuation mistakes is you have to check your ego at the door. This can become a very emotional process and very competitive process. And if you're a competitive individual and you like to win, it's easy to make mistakes because you get caught up in the process and the negotiation. Check your ego at the door. Don't become emotional. Look at the facts. Make sure you're not making a mistake that you can't recover from later on. The next item on the list is you take on just too much leverage. You just take on too much debt to acquire a business. And look, that's easy today. With today's interest rates, it's easy to do that. You can look at a deal pattern and say, okay, I could take on this much debt at today's interest rates, and I can cover this nut. And so I understand that. But most loans are not fixed rates. Most loans are floating. And while today's interest rates are at historical lows, if those rates start to notch up a bit, and all of a sudden your monthly principal and interest payments go up by 10% or 15%, all of a sudden you might have a hard time making those debt obligations. So you have to factor that in. You can't just take a look at what's your debt today based on today's interest rates. You've got a floating debt loan. What could happen? And model that out and make sure that you've got enough comfort and enough room in the financials in that business that if that happens, you can weather that. And I would be conservative here. I would measure that assuming that you don't grow the business at all. Just assume steady state and play with the model at different interest rates and see what happens. The other thing with too much debt is a downturn occurs. Look, I've lived through two significant ones. We've had the recession of 2008 and now COVID. And so it's hard to model in these sorts of downturns. These are really significant, and who could ever, imagine these things? But it's important to try to at least think about that. If there's a downturn, what happens? And can you make those debt obligations, and can you still take care of yourself and your family or your employees? And so modeling some of that, while I wouldn't spend a ton of time on it, it's important to understand, and that will keep you conservative and to make sure that you don't take on too much debt and too much leverage. And usually when you do this, the result is that you overpaid for the business. And perhaps you didn't put in enough equity. So those are other things to be looking at. If you overpaid, leverage goes up, or maybe perhaps you were looking to put in a minimum amount of equity, and maybe putting a little bit more equity in up front will reduce your debt burden and your leverage and give you the runway. The next item is you overestimated growth or synergies. And when it comes to growth and synergies, I have to say, I see time and time again, people have the tendency to be very aggressive. You know, we have a famous saying in our business, people pay owners for what they built, but they buy a business for what they think they can do with it in the future. And it's natural. It's natural to think you could take the business to the next level, that you could bring your skills and your experiences to that business. And whether you're an individual investor and you think you could take that business to the next level, or you own a business and you're looking to acquire a business and merge it into yours, and you're going to get some synergies. Synergies like you can reduce some overhead, maybe reduce facility costs because you're merging that business into your facility. You know, there's models that you can do here, but time and time again, I see that people overestimate what's possible. And, you know, one of the things to remember, especially right now, is growth through organic methods has become very hard. It is really hard to grow a business organically. And so my tendency here when I look at these models is to have people be conservative. Really take a hard look at it, and sometimes even look at your model and maybe just cut it in half. So if you've got a growth of X, cut it in half and see what that looks like. Because what you don't want to do is have an expectation of the business and then fall short and you overpaid or you took on too much leverage and now you can't, again, meet your obligations. One of the things that happens also in the growth and synergy phase is you're going to meet with an existing owner, and the owner is going to lay out for you. And one of the questions that you should be asking in diligence is, you know, if they wound back the clock 10 or 15 years, what would they do to grow the business? And usually the owner is the best person to tell you how to grow that business. But you want to dig deeper. You don't want to just understand what they think could happen or what areas or what methods they would use to grow the business. You want to understand whether or not they tried any of those methods. And if they didn't try any of those methods, why didn't they try them? And if they did try them, what happened? So there's an onion to be peeled back here. You understand, you know, what the owner's knowledge is, what their experiences are. And then the other thing to understand about growth is what sort of investment is it going to take to grow the business? Most growth comes with a significant investment. And so that's going to be cash out of your pocket post-transaction. And there's another reason why some people can't meet their targets or a deal fails, because they just didn't have the capital to meet growth expectations. And the same thing comes with synergies. You know, it's going to cost you money to bring a business and integrate it into yours. You know, you've got to move it, you've got to move employees, you might be paying stay packages for employees. Whatever the case may be, there are always investments to be made, whether it's for growth or synergies. My overarching comment here, be conservative. Really look at it strategically and be careful so that you don't miss your targets. Next item on the list is that when you conducted due diligence, it wasn't comprehensive. It was, in essence, weak due diligence. You know, and I'll tell you, diligence is hard. We've done a couple of episodes on this. We've tried to really go deep into what's involved. Diligence is something that goes way beyond the financials. And especially now, during COVID, diligence has taken on a whole new perspective. There is so much more to consider during this COVID environment, especially if you're buying a business that was impacted by COVID, positively or negatively. There's a lot to figure out. If it's negative, is that impact just temporary until that business can come back out the other side? And if it was positive, if COVID had a positive impact on that business, is that also just temporary? And is the business going to come back to its historical levels? And this is really a cautionary tale right here. You want to make sure that you're not overpaying for businesses who have experienced growth during COVID, because if we get back to some level of normalization and that business comes back to historical levels, chances are you overpaid and you're going to have a tough time meeting your debt obligations. And remember, you're an outsider. It's impossible for you to uncover everything in diligence. It's just impossible. You couldn't spend enough time to figure it all out. And so you're going to want to make sure that you have experts. And I don't mean just one expert. I mean having experts, maybe even at the functional level, depending on what type of business you're buying. So while it's obvious that you would bring in a forensic accountant or a CPA or somebody that can help you with the financials, you may need experts around HR, communication, marketing, whatever it is. You need to think through all of the aspects of that business and whether or not you should bring in an expert to help you conduct the diligence. The other recommendation that I make here that I see people make mistake I see people make every now and then is they don't spend enough time with the balance sheet. They spend so much time on the P&Ls and the tax returns to figure out what the adjusted EBITDA of a business is going to be post-transaction. They don't spend enough time with the balance sheet. And the balance sheet will tell you a lot. It will tell you how much cash that business needs to operate with day in and day out, month in and month out, what the seasonality looks like. If it's an inventory intensive business, what's happening with inventory, what you need to be prepared for there. All of that balance sheet work should get you to a really important metric. And the really important metric is, what is the necessary net working capital of the business in order to sustain the business at its current levels? And so what's net working capital? Net working capital, very simply, is your current assets less your current liabilities. In most deals, unless it's a stock transaction, you assume that you're not going to be taking on any of the cash, and you're not going to be taking on any of the long-term debt of the business. The owner gets to keep their cash, and they have to retire all of the long-term debt. And perhaps then you are assuming things like payables, account receivables. I'm sorry, I'm going to do that again. It assumes that you're taking on things like accounts receivables and the inventory, and also the current payables and any current obligations that the business has. And that calculation, those current assets minus those current liabilities, will give you your net working capital. And that's an important number. And then once you have that, you probably want to spend a little bit of time modeling that, because if you have some growth expectations, you can back into what sort of capital you're going to need to fuel that growth on the balance sheet. And then the last thing I recommend around due diligence is to do some modeling for unforeseen events. I wouldn't spend a ton of time in this area, but I would spend a little bit of time. You know, if you had a downturn in the business, 10, 15, 20% downturn top line, what would that mean to your bottom line? And what would that mean to your cash position? And what would that mean to your net working capital position? It's worth spending that time to figure it out, just so you know that if that happens, you're going to have the cash, you're going to have a line of credit, whatever it is, to withstand any sort of downturn like that. And you can model some other things that go beyond financials, like, you know, God forbid you have a technological breakdown or a data breach or some other things like that. You need to understand what your backup and contingency plans are. So due diligence is really, beside the next topic that I'm going to get into, integration, is really probably the most important thing that you can do, and one of the biggest reasons deals fail. People just didn't do the proper diligence. So the next item, integration. This is probably the most critical step in securing the success of an M&A deal. So you've done the deal, and then how do you secure success? And how do you meet your ROI targets? it is definitely a complex process. Integration touches every part of the operation, and a detailed plan is really required here. So let me talk about, integration and what are the best steps and what are my recommendations here. First off, somebody, whether it's you as the acquirer or somebody that you hire, somebody should own the integration process. And that should be their sole job. They're responsible for making sure that the entire integration process is a success. Everybody in the process has to report to them. They set the parameters, they set the plan, they set the goals, and they do the check-in points, whether that's daily, weekly, monthly, whatever it is. But somebody has to ultimately be responsible for integration and making sure that it's a success. I'm going to do that again. Somebody has to be responsible for integration to make sure that it's a success. And what you don't want to do is parse this out to department heads and just expect them to operate on their own. While you're going to probably give a department head or somebody who's the head of, a functional area, their responsibilities, it should all funnel back to somebody who owns the entire process. It's my number one recommendation when it comes to integration, so that you make sure that nothing gets missed and you have one person that you can go to that owns it. So when you think about integration, it cuts across every phase of the operation. It cuts across clients and vendors and employees and technology and marketing and sales. You need to have a plan for each phase. But I'll tell you, the number one issue in integration is the people. I've said this before on many other podcasts. I'm going to say it again. The people are the number one asset that you're acquiring. More important than the clients, more important, I think in many cases, the technology and the vendors. People are what make the business operate day in and day out. If you take care of the people, if you get that right, mostly everything else will fall into place. You're going to probably still have some hiccups along the way and speed bumps, but getting the people right is job number one here. So don't shortcut this step. Spend an inordinate amount of time on the people, making sure that you get it right so that they then can turn around and take care of your investment. The next one is culture. And honestly, this is something that you need to figure out in due diligence. Culture clashes happen. We've seen it. Two companies coming together, or even an individual investor taking over a company, and they miscalculated the cultures, and they take over, and shortly thereafter they lose a key employee or they lose a key client because the cultures just didn't match. They just didn't have the same underlying foundational beliefs, and something can quickly unravel there. So you want to make sure that you spend time in diligence around culture. And then once you understand what the culture is, when you're in integration, make sure then you support whatever that culture is. Cultivate it and make sure that you follow through on what your early findings are so that you can maintain the same culture that you saw early on. Underlying integration, the foundational piece of integration, my last point here, is communication. You need to have a really good communication plan for every aspect of the transaction and the integration. Internally for your people, externally for clients and vendors. And you want to make sure that plan is built even before you have closing occur. You want to know what you're going to say hour one, day one, week one, and have that plan built out at least for the next couple of weeks, so that you've got something to follow and you're showing consistency. And then you can modify the plan from there. But having a good, solid communication plan, again, is the solid foundation for making sure that integration goes smoothly. And then the last piece, and the last reason that I see M&A deals fail to meet their ROI targets, or fail completely, the owners retain the wrong advisors. And I've spent a fair amount of time, again, in other podcasts. You've heard, if you've listened to other podcasts at M&A Unplugged, you heard professionals speak about how important hiring the right advisors is. And to peel back the onion here a bit, you need people surrounding you in your transaction who live and breathe mergers and acquisitions. They know what it takes to get a transaction done. They know what's happening. What are the current trends? I mean, I'll give you a perfect example. COVID has thrown everybody a curveball, and it's not just in the operation of their business. We're now seeing all of the legal documents in a transaction change pretty substantially to accommodate for a post-COVID environment. Reps and warranties, indemnifications, and those are just some of the simple things. If you don't have an M&A attorney who specializes in doing transactions, they may not understand what the trends are and what's happening, and they could miss something really important. Same goes for accountants. There are tons of great accountants out there, but then there are people who really analyze M&A transactions and take it a step further. They get what it means to integrate a business in, and whether or not synergies that you're modeling out make sense. They can even get involved in some of the growth expectations that you're building and give you feedback there. They certainly can be very helpful when it comes to calculating net working capital. And then M&A advisors like ourselves. I mean, we do hundreds of deals. We see just about everything there is to see. We help people avoid mistakes all day long, or get ahead of issues that we know are going to occur. So getting the right team and the right set of advisors can really help you avoid the pitfalls and help you from having an M&A deal that fails or misses your ROI targets. In wrapping up here, I'll just say that acquisitions are typically the largest transaction an individual or a company will do in their lifetime. And it's also something that people don't do day in and day out. So you need to surround yourself with the right team. You can avoid these common pitfalls. You really can. Most deals don't go south. Most do miss their ROI targets. But if you educate yourself, you surround yourself with the right team, and you build the right plan, I strongly believe you have increased your odds of having a successful transaction. I hope you enjoyed today's content. All of today's information will be available in our show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.